Yo, what up, guys? So it is 8:30 in the morning. No sleep yet, but we are in GJ shorts. Look at that entry, man. The entry was absolutely beautiful. Set a limit order. We are, I don't know how many pips in profit, man, but this is a beautiful setup. I got it in the Discord chat right here. Let me go ahead and show y'all what I posted really quick. So this is my analysis for the most part. You know, we seen that price is making these lower lows. Made another new low. It wicked off to the upside. It pushed up one more time, giving another opportunity for most retail sellers to come in and look to push price to the downside. I was looking to sell after a grab of the liquidity. So basically, if we would see a push up to this level, this would be my most stop losses were. So basically, I was anticipating stop losses to be grabbed before pushing to the upside. So instead of me entering around this level, I wanted to enter the sell a little bit above this level, which is where most people will look to go long. So it's a little bit of, you know, what the opposite was happening here. But this 30-minute time frame analysis, see that the limits were triggered. Beautiful entry right off the dump. And then if we keep scrolling through, a little bit more reaction, and then keep scrolling. A little bit more profits, a little bit more profits. Overall 40 pips, TP2 hit. Overall a very nice trade setup, man. Guys, salute to all y'all who are watching. This is BJFX. I'm coming back to y'all with another video. The purpose of today's video is actually walk you guys through some trades that we took last week on GBPJPY. So right now it's currently 3:45 a.m. I was looking to trade London session. I did see some potential setups occur, but most of them, you know, not really too much is going on right now. Monday just passed. It's currently Tuesday night, Tuesday morning, whatever you want to call it, but nothing is really showing up, so I figured why not hop on here, make a video. First setup and be walking you guys through is going to be GJ longs. I believe we took these longs on Tuesday during London session, and this trade was a 10 pip stop loss with a potential 30+ pip reward, give or take, depending on how long you wanted to hold it, whether you were a swing trader, day trader, scalper, etc. Me personally, I am a day trader, so I'm usually getting out of my positions within a few hours. Sometimes even less, depending on market conditions. You know, like I say in previous videos, market conditions are forever changing. So you might be a day trader, but your take profit might be hit so fast that it's considered a scalp. You know what I mean? So the market's always changing. Average daily range is always changing. So it's just the best thing to do is really just be adaptable and just look for the best possible setups based off of your approach. So I'll go ahead and throw up the GJ longs up on the screen right now. Aside from the GJ longs, we also took GJ shorts a couple of days later. These sales are very nice. I'll go ahead and throw that up on the screen right now. The sales, I believe, were a 20 pip stop loss with an 80+ pip reward. Now, unfortunately, we did not get our final targets hit for 80 pips, but we did get our 50 pip target hit literally within a few minutes. Now, this trade was, you know, taken pretty late into the London session. This wasn't taken around London Open or anything like that. I was actually actively in this position at around 8:30 a.m. So that was an all-nighter for me. And overall, it's a very nice trade setup, man. So I hope y'all enjoy this video. As usual, if you do enjoy the content, you do enjoy the channel, make sure to hit that subscribe button down below. If you like the content, you get some value out of this video, make sure to leave a like as well. So that's pretty much it. Like I said, I hope y'all enjoy it. I'll catch y'all on the charts. Alright, man, so we have GBPJPY thrown up on the 15-minute time frame right now. We're rocking with the solid colored candlesticks, all black candlesticks right now, man, mainly for psychological reasons. I got that question a lot. You know, a few people ask me why I do this. You know, sometimes it really depends how I'm feeling. Sometimes I'll go with multicolored candlesticks, but for the most part, the reason I do this is because regardless of what color the candlestick is, we have, you know, as a whole traders, we have associated certain feelings with colors of candlesticks. So if you're looking at price, you're looking to enter a trade, for an example, let's just say you're looking to sell a trade and it approaches resistance and you see this candle is green. I'm sorry. You see the candle's bullish and it's green on resistance. That's gonna trigger an emotion. You know, even if it's subconsciously, even if you don't realize it. You guys know that I preach a lot that trading is very mental. So if you see that this candle is green, it may begin to trigger a certain emotion and trigger doubt, maybe fear. And what fear does is it makes your decision making irrational. It then switches from I'm trading on the charts to I need to survive, because you know that fight or flight feeling. I used to get that when I trade. You know, when I used to trade, you know, especially big lots back in the day when I first started, I would get a rush. But the more I found ways to do the inner work to calm myself, the better my trading actually was, you know, because I'm able to stay level-minded through it all. So I think that's one of the main reasons and main benefits of me using the solid color candles is I don't really have to worry about the candle being bullish or bearish, even though your eyes are going to pick up on it. Like if we look right here, we obviously notice it's a bullish candle, it pushes up, it rejects, and now it's bearish. But for the most part, when you're in the moment, you don't have to see the fluctuation of the color. Like I said, that's just something that personally was something that I realized when I was, you know, especially as a beginner trader, I'd focus a lot on the color. When I realized regardless of the color, that's just the feeling I have associated with it. You know what I mean? Regardless of the color, price is price, and the way it reacts and moves, open candlesticks, closing candlesticks, it's gonna move the same regardless. So that's something I did. You know, I'm enjoying it so far. But yeah, I just wanted to get that covered real quick, man. So let's go ahead and get into this analysis. So we're on a 15-minute time frame right now on GJ, and let's see, I have the charts rewinded. I actually went ahead and went long on this pair somewhere around here. I believe it was like 138.72, and then the stop loss was something like this, and then the TP was around 30 pips, I believe, 36, maybe a little bit less, but it was something similar to this. I'll go ahead and play this, let you guys see how it actually played out. You know, I believe it was a 10 pip. Yeah, we were working with a 10 pip stop loss and a 30 pip reward. So this was the trade setup. And I had a few questions from people, and they were asking me, you know, why did you go long right here? Because for the most part, this looks like a break and retest situation where most of the time, most people will look to sell. So that's what I'm going to get into in this video. Let's go ahead and get this erased real quick. But yeah, man, so this was the trade setup. The first reason I actually looked into it, let's talk about liquidity a little bit. So this is something I told my students recently, and I've really been stressing a lot, is liquidity. Not only, okay, the concept of this is that not only do you want to think about your approach to the markets, you need to understand the retail herd as a whole and what they're looking to do. Because I'm sure you've heard the saying that 90% of traders lose their 90% of money first 90 days. You know, the average retail education is the same. Sell on the break and retest, buy on the break and retest, use the Fibonacci, wait for the moving average crossover. And this is all things I use. You know, this is all stuff that I put into my trading. And I've realized a lot of people ask me, you know, what type of trade approach to use. It's more of a combination of everything and a combination of things that I've learned from personal experience. So hopefully I can give you guys some value and y'all can learn from this concept that I'm about to get into. So liquidity, right? If we were to remove all of this off the screen and we were to rewind this, you know, if we were seeing this looks like overall a downtrend. So if we go ahead and we get, you know, this right here and we draw this key level, we can see that this is what most would call support, turn into resistance, a little break and retest. You can also draw this level out. You can also draw this level out. You can bring this down a little bit. And then you can also draw this level out. So for the most part, through each one of these levels that are broken and retesting, I'm gonna go ahead and put a money sign. We have what we call liquidity. Now liquidity is going to be the retail trader stop losses. Okay, it's going to be stop losses all throughout this area. So this is basically money in the markets. And for the most part, we know that the market doesn't move like this. Okay, the reason the market doesn't move like this, okay, is because if the market was to consistently move like this, everyone would just sell, close, sell, close, sell, close, and money would constantly be pulled out of the market. Now the thing about the markets is that this is a zero-sum game. So when you're making money, somewhere somebody else has to be losing it. So this is why I preach sometimes, don't necessarily go against the trend, but understand and try to think logically of what the 90% are doing, because a lot of the times they will induce a certain type of order and it will go completely against you. And this is something you can really only learn through intuition and practice. Of course, as concepts, you'll hear a lot of people talking about like institutional trading and stuff like that. And the reality is that no one's trading like an institution. There's the lingo, there's, you know, different stuff people say, different methods, but it's all based around the same concept of liquidity grabs and stop outs. So in my opinion of the markets is that for the long term, you're looking at fundamental moves. If the US is doing bad, the value of the US dollar is going to fluctuate based off the condition of the economy. Okay, in the short term, being that we are in 2020, retail trading is more active than ever. Okay, with companies like iMarkets Live, a lot of people marketing Forex, portraying it as like a major new business plan, which it is a great opportunity, trading as a whole. But being that so many people are making this opportunity widespread, we have more and more, more and more people getting into this game than ever, which means there's more and more money around these areas of liquidity, and Forex is decentralized, so you don't have access to how many people are selling here or here around these certain areas of price. But you could think logically and know that 90% of the people that trade are given the same exact education. So it's very probable that if we draw this area out, there's a lot of liquidity in the markets. We have a lot of stop losses. So something I tell my students, man, is that, like, if you're a short-term trader, you're a scalper, you have to think that there's swing traders here as well, because a lot of people think of it as, okay, I'm selling here, my stop losses down here, take profits down here. But in reality, you got to think, okay, there's going to be swing traders up here, there's going to be position traders, there's going to be long-term holders. So you're going to have, different people in the markets around different times. You have to understand why price is going to do what it does. So for the most part, we know that there's money around this area. So what does that mean? That means that potentially we can have large money come in, large volumes, banks, institutions, etc. Whatever, I'm sure you've heard of the concept of them. Market makers, for the most part, is what I like to call them. But we know that there's a lot of liquidity. There's a lot of money up for grabs. So what do we see around this break and retest? Boom. So what we have here is what we call accumulation. So if I bring it back, the simple break and retest right here was accumulating and inducing a certain type of order. So once we see the consolidation around here, you can say that a lot of people were looking to sell. If they weren't looking to catch short-term movement, they were looking to catch and capitalize off of some type of downward movement. So the statistic is most likely, thinking logically based on what most people, the approach most people use, we know that, they probably wanted to go short, so there's a lot of liquidity. This is the accumulation. We're inducing a certain order, and then what are we doing next? We're, boom, pushing price to the downside and triggering the factor of greed, because remember, the retail herd, we're human beings, so we're going to react in certain ways. So this big bullish candle here triggered a lot of greed, and we caused more money to get into the markets. Once that greed was triggered, once we seen price push to the downside, this right here gave a lot of confidence in what these people are doing who entered right here. Because if you think about it, if price was to instantly begin to push to the upside, let's pretend none of this happened yet. If price was just to push up right here, people might cut losses quick. But if they see blue screens temporarily, get into a little bit of profits, they might hold on to it, because once again, they're triggering the factor of fear. We know that fear leads to irrational decision making, right? So if we go ahead and we remove some of this, you can see that this was my overall concept of going long. I felt this market was very overextended. I also was looking at a couple of concepts on the higher time frame as well, which I'll get into in a little bit. But this was the trade setup. I guess you could say like 10 pip stop. It says a reward 30 something pips. So this first trade setup here was more aggressive. It was higher risk, but it was against the overall herd of the market. So you can say that throughout this trade, if you were risking 2%, you could have, if you use a percentage-based risk, of course, this would have been 2% risk for a 6% return. So me personally, I'm always risking 1 to 2%, easy. Any given day, never risking any more than that. So 2% risk for 6% return. That would have been an overall 6% return on my account. Okay, me personally, I risked like 1% on this, so it was like a 3% return. But once I did that, right? Once I did that, I was then out of the market with profit, so I'm profiting at this point. So now what I'm doing, being that this high is taken out and this high is taken out, I want to ask myself, what type of continuation is this going to be? Once we see the accumulation and price distributing itself through these zones of liquidity, what are we going to see next? Are we going to see a continuation of this downward trend, or are we going to see a push to the upside? So now that I have a small advantage over the market, I have a little bit of the market's money, I'm going to go ahead and say that price is going to push itself up. I need to choose a direction. So by building up a little bit of confluence, I believe that price is going to go up. So we had this W formation, brought it up to the high of this candle, and this would have been your second opportunity to enter. Now me personally, I didn't enter it, but I'm just metaphorically speaking. This would have basically been how you could have rescaled into this trade, and this would have been a 618 entry. And then final targets would have been your negative 618 up at this previous level of support resistance. So if we look right here, what price does, remember we're looking to enter at the 618 fib level, measuring from the low all the way up to the high, and then boom, we're perfectly tapped. Now look at it, this was literally like a cheat code, because I watched this happen in real time, but I was content with the profits I had on my first trade, so I didn't really want to scale into it. Any type of situation like that. But keep in mind, once you were over on the market 6%, you could have risked another 2% for a potential 8%. So you can see the major rejection, and then boom, price begins to take off, going through that zone and reverse and back to the upside. So that was pretty much it for the longs on this trade. Let's see. I'm gonna wait for the other trade. I'm gonna go ahead and wait. So here is the sells. Here's the sells, right? So once we do see the push to the upside, you know, I caught the buys, and this was just the second entry that I explained for 60 pips. It was more just me trying to kind of get the point across of how you could have rescaled to gain more just based off of that movement that you were anticipating, right? So we see right here that price made these highs, and you know, I used to use trend lines a lot for this, but when I'm looking at the overall highs of the market, something I would have probably did, I would have just drew a horizontal line around this level. I would draw another horizontal line, and I would draw another horizontal line. So basically the way I would approach this is, if price was to break through, that would show me that it's pretty strong. If it was to break through this, that would show me that it's fairly strong. And if it was to break through this, that would show me that buyers are pretty damn strong to be able to go through all that. So now we see the rejection, we see a little bit of a pullback, and then you could also draw a trend line. So what do we see here? We see people trying to push price up in this direction until we finally see a break of this key level. Now what we see here happen is actually price make this low, it breaks through this entire area, doesn't even really show any reaction to it, it just immediately breaks through, and then we see a pullback. So this is back to what I was saying about previously. People are drawing this level, and what we have happen here, if we were to go ahead and get our ruler, we can see that this was like a 15 pip, you know, stop loss being hit. And we know statistically most people nowadays, they want a day trade, so stop losses are very tight. 15 pip stops, broker spread fees of 5, 20 pips stop loss hit easily. So you can see how this was set up. You know, you see how we had these wicks, we've seen a lot of rejection, and keep in mind this wasn't a trade I took or anything, I don't believe, but this is just me recapping it. My trade that I took, I'm gonna get to in a little bit. But see the wicks here, this shows volume. This is showing that there's a lot of active trading. There's active retail traders in these markets. They're attempting to push price down, and then what do we see happen? Liquidity grab. There's retail money up here, and if we were to go to replay, right here and work our way down to the 5-minute, what happens? Price pushes to the upside above this key level, and then boom, we're all the way back through. So you can see how that basically happened. We're inducing the order. So keep in mind, price makes this level, and everyone has these zones drawn out in a different way. We see the rejection, we see a pullback, and then what do? We induce a lower low being made. A lot of retail traders look at this lower low as a sign of bearish pressure. So what do we see after the lower low? Push up, a little bit rejection, boom, 4 or 5 or maybe 3, 4 consecutive bullish candles stopping us out for exactly 15 pips. So that's pretty much it for that concept. Let's go back to the 15, and I'm going to explain to you guys what we have here. So now we have a new low being made. So once again, the market's pretty overextended. You know, a lot of people can be looking for sells around this time, so we need to be mindful. Do we want to get in with the retail herd, or do we want to potentially, you know, stay back, risk missing it? You have to be okay with missing a trade if you're trading this approach. Okay, and keep in mind, this approach does take a decent amount of time. So what do we see happen here? See price make this high, right? It makes this new low, it makes a new high, it makes a new low. So what are we probably going to see? We're probably going to see a new high. So what I did was I drew my Fibonacci from the low to the high, and we can see that, you know, statistically, I like to see, just based off of back testing, I like to see a retracement, you know, of this zone right here. So I like to see a retracement up to this zone. A lot of people wanted to sell right here on this break and retest, and you can see that above this there was probably going to be stop losses. And then what do we see? Prices pushing to the downside. And I remember looking at this in real time. I seen it fail to break this low, okay, and we make the new low, and then what do we see? Price spikes back up. Okay, it spikes back up. So what do we have here? Price showing rejection, make a new low, and then what are people doing? The retail herd is following through with this flow, and we're inducing an order. They can let them win a couple times, because keep in mind, the tone isn't really set on the trend at this point. If we're to go ahead and remove some of this, if we were to draw this, no one was really looking to sell until this area right here, because so they could set this up. The market makers could set this up, lead it to a 1-2 move. Most people are entering around this point. So you can see how we have this break and retest, right? You can see how we had this break and retest. You look to enter here, boom, 36, 37 pip stop loss. Because if we were to rewind the charts, We don't know where the market's going to go at this point, but we do know there's liquidity right here. There's a lot of liquidity. So usually in times like this, I don't like to enter. You know, I'm usually going against the market in times like this. Okay, how do you go against it? I'll get some videos about that in the future. Also on my course, I'm going to upload a ton of stuff about this. But so look, where I actually got into the market wasn't around this area. I did go for sales, but I mapped out this previous high, and I wanted to see a break above this high with an institutional candle. Okay, that's the lingo for them. It's called an institutional candle. Oh, didn't mean to let that play. Right. So what do we have here? I might have to go up to the 30-minute for this. So we see how we had this indecision candle after a push to the upside. Basically, if we bring our fib from here to here and then go up to the hourly, you can see that we had this indecision candle. What I did around this level after we seen the liquidity grab, if we go ahead and we put this right here, after we see this push to the upside, we see the indecision candle. So I entered on the close of this candle with a stop loss of around 20 pips, with take profits being potentially around 80 pips, I believe. So that was our TP, right? This was our take profit. And for the most part, I ended up getting out of this trade with, I believe, around 40 or 50 pips, give or take. So if we work our way down to like the 15-minute, you can see that for the most part, you know, there was a lot of selling going on around this area as well as this area, especially if we were to rewind the charts and look at it from here. So no one's really expecting that move. Usually the move to the upside, you know, like this move here is usually going to be the strongest because that's the most volume being pushed into the markets to grab those stops before seeing another push to the downside. So that's something I want to make more known, is that a lot of these people trade the same methods and then wondering why am I not profitable. And I'm not saying support resistance doesn't work, I'm not saying none of it works, but it's the approach in itself. Entering an overextended market. So you might be wondering, BG, if this so-called works for you, why are you sharing it with other people? I could share it, all I want. Only certain people are going to catch on to it. People are still going to trade the same methods consistently. People are still going to do the same approach. But in my opinion, you can learn support resistance. You can learn moving averages. The main thing is practicing with it enough so you can understand when you should be using the method and when you shouldn't. So I have a very systematic approach. Like my approach is pretty technical, but I'm only using the technical approach in certain market situations, if that makes any sense. So I've been recording this for like 20 minutes now. I'll go ahead and wrap this video in a little bit. But you can see right here, we're very overextended. And if we look at these lows, what do we have happening? We have these rejection candles. So what is this rejection candle showing us? These rejection candles are showing us, boom, push it upside, boom, push it upside. All of a sudden, we have very strong buying. So we draw this level out. Prices failing to close. People are looking to sell. We don't even see a new low being made. So we see this rejection. We see another push to the downside with rejection, but we still have rejection around this area. So if I was to see a break of this low, then I would be like, okay, I'm going to go ahead and take a step back from this. Maybe it'll continue to push to the downside. But being we had 2 wicks, for the most part, that's showing me that buyers are still there. And I wouldn't be looking to enter yet, especially when we see the retest. Because prices coming back down, 90% of people are hoping that that candle coming down was to continue the downward trend, when in reality, that candle was a simple retest before shooting back up to the moon. That candle was a very simple retest, and then it was like boom. So yeah, man, that's pretty much it. I hope y'all do enjoy this video. This is what happened after. So keep in mind, there's multiple types of accumulation and distribution. This was basically accumulating sales, grabbing the liquidity, pushing the markets back to the downside, but then going back up with the upward trend. Usually you'll see something like this occur, where it's like boom, fake out, then back to the downside. You'll also see something like this where it's like boom, fake out, but then going back and then going back up. So there's a few different patterns, few different methods. Yeah, man, it's a lot to explain in this video. Like I said, I don't really have enough time to dive through everything about volume, institutional candles, liquidity, stop outs. Just the main thing in this video I'm trying to get across is that short-term moves, a lot of this happens based off of liquidity and the amount of money in the markets at certain amount of times. Overextended markets bring the best opportunities. One quick tip: buy when everyone else is afraid. Do not buy when everyone else is greedy. Okay, keep that in mind. And that's not financial advice. That's just what has worked for me. You know what I mean? So that's pretty much it, man. Hope y'all got some value from this video. If you have any questions, please comment them down below, and I'll get to you guys as soon as possible. Like I said, if you got some value from it, leave a like on the video. It's your boy BJFX. I'll catch y'all very soon. Peace.